Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I am doing all good, Joe. Over here in my my secondary location here in the home office. My mother is 82 years old and lives with us, so we are quarantined from going upstairs in my house to visit with her. And I am in my new location, my new podcast location, which, you know what? I think I actually might even like it better. So I'm feeling good.
It sounds nice. It sounds real nice.
Does the sound sound good?
Yeah, great.
I'm in a smaller room than I normally am. So, smaller room, but bigger minds. I don't know. I'm excited. I've been having a lot of brokers and friends sharing some positive stories and positive news the last 24 hours. So I'm feeling fine. I feel we're safe and we're complying with everything here. We're just locking it down and enjoying our time together as a family. And, it's a good excuse to, get some education under the belt and some things that, you wouldn't normally spend time on. Plus, I'm making a pot roast today.
Oh.
Yeah.
Nice.
How about that? How about them beans? Yeah. So, Joe, where are you at?
I am somewhere along the Snake River in Idaho.
Good spot to be.
Yeah, we figured that since we were near Idaho and it is a lesser infected area, we would head there. But also because they closed down the Grand Targhee ski resort where we were, which is sad day.
Sad day.
But I've got to tell you, Julie, the last day on Sunday was the best day of the year. And
where were you?
We were at Grand Targhee in Wyoming, which is like right on the Wyoming and Idaho border. But get this. So first of all, we saw that there was going to probably be a good amount of snow on Saturday night before the Sunday morning. And so we paid the extra like $90 a person to do the early tracks, which start an hour before anybody else. And they only let 27 people, including instructors, up on the mountain for an hour.
Whoa.
So it snowed. We had, I don't know, somewhere around 15 inches of fresh to ourselves. Sweet. For an hour. And then it took at least a half an hour for the other people to get to us after the lifts opened because we were on the far end of the mountain. It was so crazy cool.
Wow. Did you get stuck at all? Did you get buried?
No, it was pretty light. It was good stuff. And it refilled the whole day. So we stayed up there. We skied the whole freaking day and had fresh tracks on the last chair.
Oh my God. I'm so jealous. We were looking forward to spending 3 mornings a week up at Stevens and, now they've shut it all down. So now our afternoon project either today or tomorrow is to go get our bikes tuned up. We've shifted to biking, right? And just in time, as you might have noticed, I made a post that I found my bike rack keys after a year. So I'm trying to, want to have some good vibes for myself and my friends and everybody else. So I put out a post that, hey, let's share little mini victories with each other, on Facebook or wherever every day. Facebook's probably the easiest. So I started this yesterday, and my mini victory was that I have had the bike rack on the back of my SUV, which is a GMC Acadia, for a year. Last time, you guys all probably saw me driving that car. The bike rack was on there. It's never come off for at least a year because I can't find the damn keys. And what happened is that Katie's hands are getting so chapped and ouchy from all the hand washing that I went hunting in my house for this heavy duty, Eucerin hand lotion, right? I knew I had some somewhere. And so thank you, coronavirus, for allowing me to find the keys to my bike rack, which were sitting right next to this bottle of, heavy duty lotion that I found. So there you go. There's my small victory. I was like, wow, this is great. And I'll tell you, ever since that moment, more things have happened. So I'm going to share them out on Facebook. Hope you all can join me. If you're on my personal page or on Seattle Investors Club, I encourage you all to share little small victories or big victories or whatever they are every day. Funny ones, little easy ones. Keep us all uplifted and entertained during this time. So it doesn't have to be about real estate. Not at all, right? I found my damn keys to my bike rack. It is such a relief to me. So right on. Well, I'm going to get to it here, guys. We are stoked today to bring you some really, really, really good information from our buddy and your buddy. Lots of you know him. And if you don't, you will soon get to know him. Albert Bui. We're going to talk to Albert today, who's one of our most talented lending friends. Albert is with Avenue One Capital, which is his own lending firm, which he'll explain to us in a minute. And today we're going to talk about how to increase your qualifying power for your borrowing needs. As Albert says, I'm quoting Albert here, there is much to discuss how to not only end up buying with no money in the deal, but also maintaining or improving your purchasing power on each subsequent deal. So eventually your properties qualify themselves and your lifestyle is, what you want it to be, exclusive of your day job. Let's see. That's what we got going on today. I can't wait to hear from Albert. Albert, what's up?
Hey, how are you guys doing?
We're good. We had to reschedule earlier this morning, everybody, because Albert's fire alarm in his building went off. Where are you at now, Albert?
I'm in sunny Irvine, California, which I spend part of the month at. And I'd be happy to jump into this with you guys and discuss some of the cool topics we have today.
Yeah, I can't wait. You guys are going to get to learn some details today that you might not have thought about before, which is how to set up and protect your borrowing power, and strategies from Albert on that. He's probably one of the smartest guys I know out here. I think you all know that if any of you are on Wari and watch his posts. So I'm going to start it off and kick it off before Joe does with a testimonial that I read that somebody wrote about Albert. It said, I can attest that Albert is one of the few lenders really knowledgeable in taxes. Last year, he helped me save $8,000 on my returns due to his tax savviness. Also, this year, he helped me take advantage of good losses on paper through cost segregation and keeping more cash in my pocket, all while increasing my qualifying power. So it's imperative that you choose a good lender that is tax and real estate investing savvy. So they, along with your CPA, can help with strategic financial planning. There are some strategies here that Albert is going to share with us today, but we're going to start off a little slower and reel it in and get to know him a little bit better first. So Joseph in Idaho, kick us off.
Yeah.
Wow.
Right? I get the long.
Congratulations, Albert.
Name.
That's a pretty stellar reference there, brother.
I know, that was. I was unprepared for that. Yeah.
Well, there's more goodness to come your way. Let's let everybody get to know who you are and blow their socks off today.
Yeah.
Let's do it.
So if you guys haven't heard Albert's story, we highly recommend that you go check out seattleinvestorsclub.com/33 when we had him on the show earlier and he gave us his whole background. But for people that don't know you, Albert, could you give us a kind of like a brief background of how you got to where you are today so that people can get to know you a little bit?
Yeah, I've been lending for 10 years now and originally got into lending purely to invest and understand how debt works and loans and terms and rates and what does it all mean for the big picture by focusing on the granular picture, which is the details of the day-to-day as being a lender. So I, eventually stayed in the industry as it makes a good living, and I never forgot the main dream, which was to invest in real estate and create cash flow, which is the main purpose of it. So for the whole 10 years, I've always thought about how I use lending to actually improve real estate investing. It wasn't that I lend first and then I accidentally invested. So I was a broker. I went to several mortgage companies, and now I'm back on my own. Created a firm, and we're a small team, just myself and 2 loan officers, and still continually invest. And I'm looking for deals as we speak right now. I'm doing a couple rehabs on a couple units and repositioning or increasing the rents. So that's going to be nice. But we're here to talk about the lending side. And lending wise, the topic for today was how to improve that borrowing power so that you can keep purchasing. It's something I focused on my entire time because I wanted to know, when I bought a property, how did that property immediately affect my ability to get another property? Because I don't want to be stuck in a rut and not qualify anymore. Because through my own borrowers, I've seen where they bought incorrectly, or they didn't file their taxes correctly, or they didn't put their situation together correctly, and they ended up being maxed out. So that caught my eye, and that's actually the topic of today.
I actually don't really hear anybody else talk about this topic more than you, right? So you are I would say, the go-to expert in our world right now on this, in my opinion. I'll give you that vote. You're the one that talks about it the most. And we are happy to have you here. Give us some tips today on that. So what does that mean when you say they don't maybe file their taxes properly or put their situation together properly to correctly set them up for their purchasing power on the current deal and future deals? What exactly does that mean? What kind of mistakes do you see made, and what are kind of tips that you can give us there?
Well, I'll try to take them one at a time. But what it generally means is each lender, most lenders I'll say, will, at least we're talking about 1 to 4 unit properties on the conventional space, conventional lending. They usually lend up to about half of your monthly income, and that's before tax. So there's that limit. You can't borrow up more than that limit. And how they calculate that limit is can get a little technical. So what I do is I figure out how they calculate it and position the clients so that they always have the ability to borrow more, because we're planning ahead. Even before they buy that one rental, I'm thinking about how does that rental affect their borrowing situation, what they're going to rent it for. And if I was them, how would I position myself to continually buy more rentals and eventually reach the point where the rental income can qualify for their whole lifestyle so that they don't have to, work at Microsoft or wherever.
And so we're talking about, Albert, when we're talking about the 50%, we're talking about, the lenders will let you borrow 50% of your total income.
Roughly, yeah.
For that includes your day job plus your rentals.
Yeah. Yeah, the net income from the rentals, if they're positive. So there's a lot of times most people call me and they say, oh, I made $100,000. But then after the write-offs or whatever their taxes show, I look at it and it's like a negative $10, whatever it is, negative. So the lenders will always use the tax returns. However, there are ways to revert from the tax return back to a default calculation. And you have to put the file together correctly in order to get the underwriters to buy in on that narrative, I guess is the best way to say it. That's the story.
So what are your go-to things, the first things that you look at when you're getting ready to review somebody's file or situation?
Well, mainly if they're an investor, we'll be talking about their rental properties, figuring out what they've done so far, what are they currently renting at, have they taken any advantages. I want to get a grasp of their knowledge on the topic, see if either they're researching themselves or do they have a CPA who's like educating them and an actual advisor. Because one of my niches is working with CPAs. So I always want to work with CPAs, great guys like Mark Canton and others. I love them because they know what they're doing and they understand it. So when I get on a phone call with somebody like that, their account tax advisor, it's right off. We start and we go from there. We don't have to explain or wasting time talking about stuff that doesn't matter. So we jump right off to the races in terms of helping their client. That's the one what was that? The one recommendation you received or you found was, I think I know who that client is, but we'll keep them nameless.
Yeah. Yeah. So you first find out if they're working with a professional that might make your life easier to have a conversation but what if they don't, or what if they do, or what if they don't, then what? So
then I help their tax advisor do it. So I will work with their, even if it's an H&R Block, I'll just say, I'll give them some recommendations. And at that point, because the H&R Block is not going to be able to do what they need probably for a certain real estate investor, talking multiple rentals here, at least.
Right now it's St. Patrick's Day. It's March 17th when we're recording this, guys. So
That's
some
true.
of you might not have your tax returns done yet. So this is going to be super valuable for you as you move forward to get those done this year, to think differently about how you approach that. So what are some tips, Albert, what are some tips that you can share with us in regards to how to properly do your tax paperwork to set you up for a win, or how to,
Yeah, I could point out some most common mistakes I see. Usually it has to do with the amount of days the property's in service. When you don't tell the accountant how many days you've actually started renting it or putting it up for rent, just asking for a tenant, even though it's still vacant, that counts as days in service. So a lot of people will put 365 days, even though they leased the property out in April and they've only rented it for 8 months out of the year, because the accountant doesn't know what to put. So they automatically, sometimes they don't even ask, depending on the accountant the person goes to, they may not even ask how many days you have the rental in service. So they might automatically put 365 days. And here's why it's a disadvantage to the borrower as a real estate investor, is because as a lender, we take that whole income and we assume it's annual income. Now we're taking your 8-month income and we're dividing that by 12. It's going to make it look really bad. Instead of dividing by 8 months or 240 days, we don't know any better because we're the lender, right? All we see is the tax return that somebody else filed. So that's an example right there where I see mistakes all the time. And if I catch it, I always ask the borrower, when did you put it in rent? Or I'll look at the lease agreements and dig through. I won't just take everything as a matter of fact. I'll look at the lease and I'll say, hey, you leased it up in April. Why does your accountant say 365? I'll ask them those questions.
And the point of this is that it bumps up your monthly average income.
Yeah, it makes your average look better. Correct. Because if I divided it by...
right there alone, guys, especially with the climate that we're in right now, even me, myself, I have a vacant unit coming up on a condo that I own here in Ballard. This is crucial information. So the idea is if you're averaging the monthly income over the lower amount of months that it was in service rather than 12 months, and that gives you that uptick.
Right. So if I divided it by 8 months, that number would be a bigger number, that average. And that's what I want to do personally. And what I'm trying to tell the borrower is, hey, I'm trying to help you qualify for more here. Not that we need the extra debt, but we want to have the ability to, in case we find a great deal and we're not going to be stuck with using hard money, even though we love our local private lenders, of course. But we want to use the most effective money, the least expensive money we can, if our situation works out to be that way.
Well, I mean, does it make sense about what if you want a HELOC or something like that, right?
Yeah, well, every HELOC lender calculates income differently, so that would be a mixed bag. But
okay.
But if
What else What else you got for us? You got your number of days. What else are you looking for?
Well, go back to that recommendation. There are items where you could be negative on your tax return and still have income, which seems counterintuitive. And writing off some of those depreciation on your buildings is allowed by our wonderful government, IRS. So that's one of those deductions that you can take that reduce your taxes. And I thinking that one client was able to save the returns and still count their income. So as a lender, we add it back, not to make it confusing.
Does not every lender know to do that, or?
It depends on the loan officer specific. The underwriter isn't going to do it for you. So if they see it and you don't do it, they might just bypass it. They won't recommend anything to you.
So who's the person in the loan process that would need to be told this or to
The originator, the loan officer, the mortgage planner, advisor. We have a lot of names. They're all euphemisms for a loan originator, loan officer. They're all the same. Advisor.
Who knows
consultant.
if they're experienced or if they're busy, they don't want to take the time to deal with it. They just want to get the file off the desk.
Yeah, we're all humans. Maybe they had a bad day, or their partner left them, or who knows.
Right. So how do you
So-
know if they are doing that? You just call them out and say, make sure you do it, or
You do.
Is there a way to double
gotta-
check if they've done it?
Yeah. You got to bust a JC on them and call them out,
Yeah.
Yeah.
That'd be a
So-
JB, Joe Bauer. He's
Yeah, that's right.
more
Joe
verbal.
Bauer on them. Yeah. So those are some tips. I didn't know how detailed you guys wanted to get into it, because I didn't want to be talking like,
Let's keep going.
yeah. I don't want to put people, veering off the road while they're driving or anything. You know what I mean?
Hey, nobody's driving right now. If you're driving,
Oh,
you're
yeah,
not.
that's
supposed to
true.
be right now. So this
That's
is
true. Everyone's quarantined. I forgot.
That's
Everyone's
right.
quarantined.
Well, those are awesome right there. What else you got? My favorite number is 3. So let's go for one more here.
Sure. It has to do with the depreciation still, and cost sagging is something I do as well. And we're basically speeding up the amount of stuff we're able to write off on our buildings. And the hard part about it is it's deducted on a different area of the tax return. So a lot of loan officers will miss it because it's not in the depreciation area, where like the average loan officer should know how to add back depreciation. I mean, there are newbies who don't understand that, but the problem with speeding it up or doing this thing called cost segregation is you're basically chunking down components of your building, and the IRS allows you to speed up certain components like kitchens, flooring, things that last short periods of time, and you're able to speed it up and write it all off at once. So that's the goal of cost segging, is to write it all off at once and have a huge deduction on your tax return. And I'm not a tax professional. However, from my context, how I use it is I'm able to locate where the accountant is doing cost seg, and I'm able to add that back as well. So it's kind of in the same field as depreciation, but it's written off on a separate form. So it is harder to find and to document.
There you go.
But you can do it. So that's huge if the investor is doing cost segregations.
And
So
these
that's gigantic.
are things that you should also be asking your CPA where to find these yourself, guys,
Yes.
on your tax returns. So give us some examples of cost segregation. We're talking 1 to 4 unit type stuff here,
Yeah.
right? So what types of cost segregation for those that don't know on these, you hear that on larger buildings all the
Yeah.
time. But,
Right.
a company to
Not
come in and
always.
for you.
I had a client who had buildings in San Jose, and as we know, that area is a little bit expensive, but they were all small 1 to 4 unit buildings. These were single family rentals, fourplexes, and he was able to show, let's just say, $173,000 in loss annually. However, from a lending perspective, I was able to locate it, get the accountant, we worked together and figured out exactly how much was regular depreciation and how much was from that actual cost segregation we did on all this client's buildings.
Yeah.
And we were able to get him to show $160,000 in positive income after we added it all back. So the
Wow.
guy went from negative, not qualifiable, to having roughly $14,000 a month in qualifying income to use from a lending point of view. And he's paying no
Is it
tax,
like
keep in
a
mind.
dollar for dollar add back? I mean, if you're, you know what I mean? Is the math?
We do. We add everything that's not depreciation related or cost segregation back from an income perspective. We add all that deduction back because we know it's all just accounting games pretty much. That are legal, of course. Legal accounting games is the best way you can say it.
Did you just say that you add everything that's not cost segregation or depreciation back, or you add the cost segregation and depreciation back?
I add those back. Sorry. Thanks for the correction. That's good.
Yeah.
Yeah.
Okay. Yeah. Good
yeah.
stuff. So what types of things though would people be able, because then now they're going to want to, if they're not doing it, they want to cost segregate. What are some cost segregation?
I will say I just did one for 8 properties and it cost me $8,500. But that was the lowest of the 3 cost segregation companies I personally did. So, and that's going to save me probably $80,000 in taxes. So, I mean, that's the estimate. We'll see when it actually is completed.
Is there a cost benefit return on, you need
Yeah.
how many units maybe?
I was trying to get 8 to 10 times the tax benefit. So it's costing me $8,500 one time to do it, the report. And the cost segregation company or consultant files it with the IRS. It's all done above board. I was trying to get 80,000 tax benefit to 8,500 expenditure. That was my goal. Everyone has their own goal. I'm sure every company that the borrower or client goes to will have their own metrics of what is worth it or not in their mind.
And does it matter whether it's local or out of town cost segregation company that you use?
From what I know, I believe it doesn't matter. But maybe a tax pro knows better than I do about where the cost seg person needs to be. Because they could always fly out. A lot of these companies have consultants that will fly out and inspect your buildings and do the engineering studies needed.
Good stuff.
Yeah.
Good stuff. So we have adding back cost segregation, depreciation. We have increasing your monthly income by days in service, right? On your rentals, how many days it's rented to boost up your monthly average income there. Those are all good things. Are those kind of the top three go-to?
There's another one. Some people think that once you file your tax return, you have to use the tax return, which is not always the case. There are strategies and ways to get the underwriter to go back to using the default calculation methods, which is 75% of your gross income. And we deduct that from the entire monthly mortgage payment. Sometimes that calculation is better than the tax return. And knowing how to use that, knowing how to use it when it's in your advantage is key, because the tax return may not be the best. Maybe you did have a bad year, or maybe you did not lease your unit up for half the year. So you don't want to use the tax because it's going to look terrible. So knowing how, and maybe today you just rented your unit at full market rent, right? So you want to use that 75% calculation.
Tell everybody what that is as the alternative to using your tax return.
You'd have to explain that the unit the taxes are basically incorrect. You have to invalidate the taxes. And you have to do that in a way where you explain it to the underwriter to tell them that the taxes are incorrect and invalid for the purposes of underwriting. And they're going to ask you why. So your loan officer has to know how to speak to the underwriter to get them to invalidate what should be used, and then go off the lease agreement. And that's how you get the 75% to be used. And that big difference is key. And that applies to a little bit off topic, but renting by the room or renting to Airbnb. So knowing how to explain it to the underwriter is key to use that extra.
Let's go into that right now. Let's go. Yeah. There are people that are moving towards the boarding room, just because that's the best way to get closer to that 1%. And, we know we have a lot of investors here locally eyeballing that if they're not already doing it. Plus, of course, the Airbnb, including myself. So let's go down that rabbit hole for a second. Tell us about that.
What specifically? Like the room renting by the room?
Tell us about qualifying that income or using that
renting
income.
By the room, you can use it. It's a long-term rental. It's 1 year lease, but you're renting by the room. I've had underwriters use it, no problem. The issue becomes when you live in the house and you're trying to use your rooms versus when you move out and are renting by the rooms. When you're living there, they don't count it. When you're not living there, they do count it. And how they count it can vary from when you're doing a loan on that said property, or you're doing a loan on another property, but you have that rental in the background, the one that's renting by the room. So not to be technical on that, but how we calculate the rental income varies based on those situations.
Based on occupied or not, owner occupied or not?
No. In our context, they're both non-owner occupied, right?
Yeah.
But we on the lending world, we call it the subject property, the one we're doing the loan on, and then the non-subject, meaning it's your other house that you're renting by the room, but it's not. You're refining your primary right now, but you have that rental by the room, right? That's a non-subject property because the loan app is not on that room rental. The loan app is on your primary, as an example.
Yeah.
So that matters because on the subject property, if you're doing room rental, we are capped at whatever the appraiser says is a long-term rents. So what happens if the long-term rents are $3,000, but your room rental is making $4,500 a month? So we're not going to count the 45, and that's where knowing that matters, because if you're planning a crucial purchase and you put non-refundable money down, you want to know some backup plans on how to get that income used. Otherwise, you might be SOL.
Yeah, you don't want to move forward with transactions thinking you're going to count all your income and then find out, that you can't. I mean, I don't know if you guys are a little bit ding-dongs at this point if you're, not talking to your lender before you're out there making offers where you put yourself in any type of situation where you can't get your deposit back. Don't do that. But there's the first thing you should know. Don't worry about all the details. Just don't do that. But this is good stuff. Very good stuff. What else can we talk about? How about tips for, or let's talk about what's delayed financing. How about we cover that? What is delayed financing? You hear people talk about that sometimes. And sometimes I hear people say, oh, we love delayed financing. And sometimes I hear people say, I don't really see how that's a great benefit. What is that exactly? So everybody
it's essentially when you buy it with all cash. So money comes in to buy the purchase, the 1 to 4 unit building, and there are no liens recorded, meaning you bought it with real cash. Some investors confuse that with hard money is cash, but there's a lien recorded on the property, so it's not cash, it's financing. So, because they always call me and they say, oh, I bought it with cash, but then I look it up and I see, one of the local hard money lenders put a lien on the property. So, but essentially what delayed financing is, you buy it all cash, no liens, unencumbered title, and you're doing a refinance to recuperate your money. And that's why we call it delayed financing. It's like you're doing the financing after you bought it. So that's why they call it delayed financing exception. But you can get up to 70%.
70% and any type of timing restrictions?
70% of market value up till what you paid for it. Total on your final settlement when you bought it with cash, that final cost figure. So if you bought it for 100 and there was 5,000 closing costs, you could get 70% up to 105,000, whichever is lower. So 70% of today's value, market value, not the purchase price.
And some tricks of the trade to jack up the cost then?
You come into the settlement with all your costs. That's how you do it. So like, let's say it's 105 we were talking about earlier, but let's say you bring all your rehab in and fund it. You put it aside in an escrow account, like a side account. So let's say your rehab was 60 G's, your closing was 5, and your purchase was 165 total. You come into closing with all of the 165, but you're going to get that 60 and it has nowhere to go, right? But that 60 can sit in a side account. We call it a repair escrow. It's an account held for your repairs or your rehab. But having that show up on the initial settlement statement allows your limit to go up to 165 when you're doing the cash out. So that's one of the secrets of getting a larger amount out. That's one way. If you're using financing, you can always get the hard money lender to lend all of the rehab, purchase, and everything. That's a similar strategy, but it involves using a private or hard money lender. So that's a little different.
Some a little bit expensive and riskier, right?
But then you can refinance that entire big loan out and get all your original money back. So it's another way to get your money out.
And what's the timing difference on how long for those of people thinking out there, especially
they can both be done instantly. There's no 6-month waiting on either of those. It's a rate and term. Or delayed financing is anything between day 0, the day you bought it, and day 180. The end of the 6th month.
So and you can do a simultaneous close?
You could, but in theory, you can't order the appraisal again because you got to repair the property, right? It might take a month or two. So in theory, if it was perfectly done, but then where would the rehab go? The underwriter would ask, what did you use? What did you use the rehab on? So that would be a little fishy.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So, whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. How about some tips for real estate agents? I saw a post that you had made that real estate brokers, that if you represent yourself, you can get commission towards your down payment on certain loans. Let's talk about that.
I've been getting a lot of people who happen to be agents or licensed agents, maybe not full-time realtors, but some of them are, and they've been representing themselves. So I've had a lot of those scenarios, and just took note of how you could do that to buy your own deals and have no money in the game or very little money, because these agents are getting 2.5%, 3%, and that happens to be the minimum down payment sometimes on an owner-occupied house. So you could technically buy with FHA and get almost no money down using your own commission as the down payment.
And the best part is that then doesn't count towards your taxable income, right? Does it?
I don't know, actually. I haven't actually asked. I haven't done it myself. I've just worked with clients on it.
Mark Canton or anybody you're listening, what's the word on that? If you guys know,
you should meta tag him in the background, so he gets tagged and he has to come in and address it.
That's right. Hey, and Joe, we should drop Mark's podcast in below, connected on this one in the notes as well, if you make that note to yourself there.
Will do.
But that's not for every loan, right? Not every loan type you can do that. And
no. There are certain conventional loans that can do it, because we do have both of our agencies, Fannie Mae and Freddie Mac. Freddie will do it. Fannie Mae, from what I know, or currently, will not allow you to use your agent commission as down payment. VA will allow it, but FHA won't. So there are certain loans that can't use it. You can always use it for closing costs. So what we're talking about here is using the commission as replacement for what you have to bring in as your down payment. Specifically that. Because the thread was huge, the one you found, Julie.
Yeah.
Right?
Yep.
And most people were saying closing costs, but the point with the thread was down payment, not closing costs.
Right.
The cool part about VA is you can actually use the seller concession to pay debt off of the borrower, of the veteran, and allow the veteran to qualify, which is crazy. I think that's crazy, but
right. And I saw like somebody got their car paid off or something like that.
So let's say your income didn't work, right, Julia? Hypothetically, let's say you're the veteran and your income didn't work. All you needed was that car paid off, and you had maybe $3,000 left. The seller could, in theory, pay off your car and help you qualify for their own house.
Right.
So yeah, that's just something cool. If you're a veteran,
don't know that those line items can be paid off, right? They just don't know they just don't know to tell them that's a doable thing. You'd think that any VA lender might bring that up, or no?
Yeah, I think it's a huge selling point of VA. If you're a veteran or if you served for the country, it's a great way to use what you have. I mean, the benefits are given to you. So you might as well.
What we're talking about is tips for real estate agents, and maybe even a reason to think about getting your license. So I won't get on my soapbox. You all know how I feel about that.
I know. I was about to get on my soapbox too.
Yeah, I'm not going to do it, but you quack.
Yeah, because when I put in an offer for VA, I always get a call from the agent saying, how bad VA is. I'm like, no, it's actually not as bad as what you think. It's about the same as every other loan. So it's actually better for you.
Right.
Yeah.
Exactly. So one caveat though, is that if you are both the listing agent and the buyer, like you're buying your own listing, then you're limited to just closing costs and you can't use part of your commission towards the down payment. Is that accurate?
Yeah, that would be seen as a conflict of interest because you're supposed to represent, the seller.
Good stuff. So maybe for everybody that's listening, just a little lending 101. What is the difference between Fannie Mae, Freddie Mac, and FHA loans? Just so people have a little.
There's different down payments allowed for each program, and Freddie and Fannie are considered conventional lending. However, they do lend differently. They do have their pros and cons, and it ranges all from appraisals, debt to income, to down payments, to minimum down payments as well. So they're all a little bit different. FHA is nice because they're very lenient when it comes to credit. So if you've got less than perfect credit, and you're working on it, you need to still qualify in the interim, I would recommend FHA if the scores are lower than 680. So they're just very favorable.
Out there have access to all those different types.
Everybody does.
Right?
It's just, but just lenders, we're like squirrel mode all the time. So, we're always onto the new shiny object because there's so much distraction in the industry, especially right now when we've got our craze going on in the media.
Right.
So
if you were going to be an advocate for yourself as a borrower, regardless if you're just doing your primary or you're doing, some of your rental property stuff, what would be the top things that you should look at a lender, from a lender these days when you're qualifying what lender you want to work with, right? What are the things that you think the borrower should be looking for or asking about?
You want to make sure the lender is working towards what your end game is. I mean, but if your end game is rate, then power to you. You got to find somebody with the lowest rate. But the ideal client for me generally is somebody who's looking for a longer term relationship, because I'm going to help them build their portfolio. If we're always looking at an eighth of rate or $10 fee or $300 fee here and there, it might not be the best client for me personally. However, there are different types of lenders out there. There's internet lenders. There's bankers at big lenders like Chase, Citi, B of A, Wells. There's brokers like myself. We all originate the same loans. However, we're all focused on different niches of the market in terms of who we want to work with in general. So that's my main niche, is generally accountants and financial planners and real estate investors. However, there are people who look for just first-time buyers. There's people who look for divorce transactions. Same with real estate, right? The real estate, you've got trustee sales, people who do auctions, and all sorts of differences. Canceled listings, right? So I guess the
question being is asking the lender, where you spend most of your business, like what type of.
Yeah, exactly.
Right. And that gives you an indication, depending on what you're after for yourself. Maybe you're after, your first primary, or maybe you're after, if you're looking portfolio wise and how to protect your borrowing capacity going forward.
Exactly.
You're going to want to talk to somebody like Albert, of course. Right.
Right.
So let's talk about the doing a quick claim and LLC stuff and the details on that a little bit.
Oh, that was quick, Julie. Where'd you come up with that? That was a good one.
Just a little shift there. Yeah.
Yeah.
I have some sheet notes that I don't give to you. That's why.
Yeah. I'm doing a few of those right now. So let's hear it.
Yeah. So no, I mean, just give us, some tips on doing a quick claim. I think one of the big tips I'll pull out of a rabbit hat today, might even make me look smart for a second, is that.
Oh, thanks.
I got this from you. So that if you, let's say you went back to your personal name for your, because you don't want to borrow in an LLC, or your lender won't let you borrow in your LLC name. And then after you close, you're planning to put it back in the name of your LLC. right now, March 17th, 2020, in the middle of the start, I'll say, of our storm here on our economic crisis about to come down, would it be advisable that people need to be careful how soon that they are putting that back in the name of the LLC as a precautionary measure, because it might take these lenders longer to get their loans sold on the back end? I think that was a tip that you had thrown out there. Like, don't do it like the following day, wait a little bit.
Yeah.
So
Yeah.
what about in this environment today? Give people the detail of what I mean when I say that.
Well, right now, you want to be able to let the lender fund the loan, because the lender doesn't just sell it right away. It's sitting on their line of credit. And generally, they have to go and find an investor to sell it, unless they're holding it, like a big bank might hold it. But generally, you want to give them, what I was advised was 3 to 6 months. But generally, most lenders sell it within the end of the first or second month. But what you were saying, Julie, is going back to, in this environment, why would we want to give them more time, is because lenders are taking forever to close right now. They might take up to 45 to 90 days, depending on which institution or lender the borrower's at. And we want to give them enough time to sell the loan so that that you can switch it to your LLC with no issues. Because the problem is,
if you switch it back too early, what do you risk?
You risk the lender calling the note, because they need to get rid of the loan. They can't sell it in the LLC's name. They need it in your personal name.
You see that, guys? That's a major tip today. So we don't know right now how long it's taking the lenders to get their pooled loan funds sold on the back end. Is that correct? How do we know? Or are we just going to make our best guess? Is there a way to check? Like, this is a dork question, but let's say we do a loan with you or whoever, right? Mm-hmm. And we quit claimed it to our personal. We want to put it back in the LLC. The loan's closed. Now we're wondering, when should we go ahead and put it back in the LLC? Is there a way to check with your loan officer, to see if that has been sold?
Some internal companies you can look up and see, because everybody in the company uses one system, so you can see when a loan's closed. But the sure shot way is when you get a letter from Fannie Freddie that your loan has been sold, that means it's been sold.
There you go. That's the sure shot way. They'll send you a letter, is what you're saying.
Yeah.
Your servicer or somebody might change, right?
Yeah, but servicing is not what we're talking about. We're talking about actually selling the ownership of the note. Servicing is just the person who sends you the bill, and that might change all the time, but that's different.
So if you're out there and you just did a loan and you want to put it back in your LLC's name, you should wait for the letter from whoever telling them that your loan was sold.
Correct.
There you go. Right?
Yeah.
Little tips.
I think we got them fried, huh? With all these tips
today. Yeah, I know, this is good. We do when we spread in the good word. What's your opinion about investors going to max out their HELOCs and stuff these days? There's big threats about that going on. What's your opinion?
I mean, my opinion is a little bit conservative, I guess, because I worked through all the short sales in 2011 and 12 and 13, 14. I just noticed that most of the times when I was representing the borrower and we were buying a short sale, I would see the seller, what the short sale letter approvals would come in at. And usually the second loan got nothing, like zero. One time it got $3,000, but the amount owed, the seller owed, was $100. And the bank accepted $3,000 to sell the property for that second. So what I'm trying to say is, when you've got a home equity line of credit in second position, it's very risky for the bank. And that's why they freeze it or reduce it. But if your line of credit is in first position, I've rarely ever seen a first position loan lose all their money. Usually they might go down to 50 or 60 cents on the dollar in a really bad recession. And maybe in Florida or Las Vegas, they were down to 20 to 30 cents. But those are rare areas.
I mean, aren't the investors out there talking about hey, go max out all your HELOCs and actually pull the cash out so you can go buy all these properties? That all sounds romantic to me.
Right. Yeah.
But do you really know, how long, are those properties available to buy, or when are they available to buy?
Exactly.
Or,
And you're carrying the interest in the meantime. You're paying for the minimum payment.
Right. Yeah.
So yeah, that's the consideration. Some people say it lowers your scores. No, it shouldn't, because it's secured by your house. But there are creditors out there who do a HELOC, but they forget to secure it to the property, meaning they did an unsecured line of credit, they thinking it was a secured line of credit. I've seen local credit unions do that, or they misreport it to the bureau. In that case, when it's misreported or misoriginated, the loan was done incorrectly, it will hurt your credit if you max out the line, because it's looked at as a regular unsecured line of credit from the credit bureau perspective. So I don't know if that makes sense, but I've had that happen before. I've seen it with a national credit union too.
Wow. I'm going to switch topics on you. That's a ongoing topic. Maybe we'll get two people on to debate it on either side of the issue. That'd be kind of fun, like a debate.
Well, it's a service you provide your client. I would call up the credit union and make sure they associate it correctly for the client, and so that the client can continue using the HELOC without huge swings in their FICO scores.
Right.
So I've done that before.
Well, let's move on to another question for you here before we wrap up.
Yeah.
Let's talk about having a lender recast your loan. And why that might be a good idea, how that works, what that even means. What you got?
Yeah. Recasting is basically stretching it out to the regular period of time. So let's say you're on a 30-year loan and you've paid down 3 years worth of payments, but maybe you come upon an inheritance or a big flip and you made 100 G's. You could put that $100,000 down on your fixed mortgage, but the problem is your payment doesn't go down. So what the lender does is it takes that new lower balance that you paid down and it stretches it back to the 27 years for you, and that's called a recast, because you're spreading the balance that you just paid down back to 27 years worth, and that lowers your payment. So the advantage is you lower your payment, and while you're going through this next economic cycle, you're going to have a leaner time. Your payment's lower, so you can survive easier.
And then when you need your money back, you go get a HELOC.
You could, exactly. Yeah, you get a HELOC on top of it.
So when they stretch out on the recast, let's say you only have 15 years or 18 years left or something. They're recasting it to the 18, or are they stretching it for a whole new full reamortization?
They stretch it back to the intended track. So if you're year 27 out of 30, they'll stretch it back to the 27.
But if you're year 18 out of 30 or something, which seems like, you know what I mean? You're going to go stretch it back through 18, or which isn't as helpful. They will back to 18. So it only makes advantage. There's only an advantage to it if you made a lump sum, and in terms of balance, you're ahead of the schedule, right? You're like year 10. So what they're going to do is stretch it back to year 18. What that does is it lowers your payment, because you're stretching your principal over 18 years again instead of 10, for instance. Right. So that's why your payment goes down. It's not that your interest goes down. It's just your principal is spread over longer periods. It's just managing your cash flow. That's all it really is. But that's important for today.
It is.
That's why I'm bringing it up.
Yeah. But I don't want people to veer off the road,
Huh?
I don't want people to veer off the road, Julie. I want to explain it in a way where...
That one there might be super helpful to somebody today, right?
Yeah, you're right. Yeah, it's huge, especially if you got your hours got furloughed, or if you're quarantining your house and you have to work somewhere to make money. That's going to be a huge deal. It's going to be a huge deal.
How does that work then? Somebody just is it, what kind of fees are there involved with that?
Usually you call in. You can do it once for the life of the loan. It's about, I believe, $250 to $500 one time, and they'll do the paperwork, get it recasted back.
You guys, right?
Yeah, right. So big deal.
That's a good one right there. Glad I asked.
Yeah. Yeah, it's all you, JC.
Hey, I got this off of just studying my friend Albert. That's how, this is all stuff you talk about. That's why we're having you on today. We really value this, good stuff.
Yeah, So, the reason we do that also, there's a good point you brought up, Julie. the good point you also do that for is to increase their cash flow, because if it's a rental, you could imagine if you dropped your payment, you'd make that difference in cash flow, right? So
Yeah.
that's a huge deal. And you can borrow more because now your cash flow, your income looks better on that property. Your ability to use your rental income as your borrowing income is higher too. So there's all these other benefits too.
That's like a strategy, right? Let's say you had a bunch of cash. You do that. You recast it, get your cash flow up, then go borrow more money. Get your money back.
Exactly.
Holy smokes.
It's like internal rental property burn.
$500.
Yeah. Yeah. That's most of the lenders. It's usually around 250 to 500 one time.
Why do people do this or not?
Yeah. Especially people who come upon a large sum of money usually, or they've been paying down like extra for years, right? They pay an extra $500 for like 5 years and they're way ahead. Like in terms of amortization, they're like 10 years ahead. But they come upon a time where they want to value their lifestyle more, for instance. So they need the lower payment. That's when they recast. Or they want to make more cash flow because they moved out of the house and now it's a rental. So now they're interested in cash flow. But while they live there, they want it to be debt-free, for instance. So that's a good example right there.
Boy, my mind is racing on this one.
Yeah, because I get a lot of people who say, I want to be debt-free fast. You know, how much do I have to pay extra to get rid of this mortgage in 12 and a half years or whatever?
Right.
And I tell them, I do the calculation. I say, hey, you got to pay extra, whatever, XYZ. And then they call me 5 years later and like, I don't care about it anymore. I need to relax and I'm done with working. You know, so that's what happens a lot of times.
Good one. Good one. So let me ask you, why would somebody choose to do a conventional cash out refinance versus a HELOC? Why would you choose to do one versus the other?
Well, prior, the conventional cash out was in the 3s and lower 4s, and then the HELOC was in the upper 5s and 6 and 7. If you get a big enough HELOC or high enough in terms of the value of your home, the HELOCs were there's a big difference in rate. Nowadays, with the Fed lowering the rate to zero and the Fed funds, and there's a big difference between the federal funds rate and the actual mortgage rates, which is a big topic going on right now. But the point was, why would you do it? Usually for the difference in rate, and you get a fixed rate with the 30-year. So you know for sure what the rate is through the whole term without any fluctuations or thick and thin. You know what the rate is. The upside of the line of credit, though, is you don't pay interest until you actually use it. However, you take the trade-off of having the rate risk because it can go up and down any month. But you don't pay interest until you actually use it. So pros and cons, it depends on the investor or how you're using it.
Depends on how you're using it.
Yeah.
All good stuff. Let me see. I think I'm almost getting done here. How do you see, just, we'll touch upon it. I didn't want to get all doom and gloom today, but we do want to educate ourselves. What do you see anything changing in regards to lending if we're heading into a big recession?
I mean, I'm thinking they're going to tighten up, but how much more can we already tighten up? Credit's already, I don't think it's going to be a lending related crash. As we all know, it's corporate debt or what they're saying on the media. So I don't think they can tighten up much more. It's already pretty darn full dock right now on the residential lending. But
how do you think the residential process will slow down? Like because of appraisers, because of loan processing? If you were going out there and you were going to make an offer today on something, what should your expectations be, you think? Are there some lenders out there still closing in 21 days, or are they able to do that?
I do. Yeah. They will usually charge a premium because they know there's so many applications out there right now, and everybody's bogged down with refis competing for all the purchase room, because all these loans have to be underwritten no matter if it's a purchase or a refi. And there just, quite frankly, are a lot more refi apps clogging the pipeline right now. So
what
a lot of lenders
look like. What does that premium look like?
Probably a quarter in rate to 0.5% in rate. But keep in mind, if you are going to be in that situation, what you want to do is you may want to take a rate in which you can get no cost, because you can come back, maybe in 6 or 12 months and always, since you paid nothing because no cost, on the original purchase, you could always come back and do that refi 6 or 12 months down the line. And once the pipeline gets fully refied, everybody moves through the pipeline, right? Rates are going to get better in general.
Right. So we'll cover that for a second, right? So
yeah,
rates, tell me if I'm right or wrong on this. So right now, rates are lender by lender based on essentially their work volume and if they've sold their loans on the back end. You know, I always think of it, Keith Pitch from Loan Depot, my buddy Keith, we love you.
Yeah.
Keith is the one that taught me this. So I sort of think of the 10-year treasury as like a stock that bounces around all day long, you know, and at any one moment, it's a different number, right? But for lack of a better purpose, we'll say it's 1%. So when the lender goes to lock the rate, they go at that moment, wherever they log into, and they grab that rate, wherever it is at that snapshot moment in time. And that, let's say that's 1%. Then they go and they add their spread on top of it. And this is where the difference of lender to lender to lender to lender comes in, is whatever spread they're adding on top at that time, which is dictated by their workload, right? If they need to slow down their workload because they're overloaded, they increase their spread. If they are ready to take on a bunch of new loans because they've cleared up their pipeline, the spread goes lower. So that's the difference between this 3.25 or 4% rate that you might see happening between the different lenders, right?
That's right. That's right.
And so the moral of the story there is, for example, if you are under contract and you hadn't locked your rate, unfortunately, and it bounces up, it means that your lender just got their pipeline full, or they didn't get the fee they wanted when they sold their pool on the back. So, I mean, if you can get an extension, you just need to wait until they, I mean, rather than maybe things might not want to fall out of contract these days, right? It'll bounce back down, right?
Right. Yeah.
Or you have to find a lender that doesn't have their pipeline full at that moment if you're in jeopardy. But if I was a seller these days, I probably wouldn't want to let my buyer go.
Right.
You know?
Yeah.
What do you think about what I just said?
Well, yeah, the rates have to do a lot with the operations of the institution that's offering the money. They all buy the money at the same rate. The difference is how they operate and how they're buying and selling their pools or their mortgage money. And that's what's causing the rate to be different at every lender. But the actual pricing and where they get the money is the same. So that some lenders have more staff, some don't have staff. So your speed of closing and your service may be massively different. If you value price, maybe you find a lender that's understaffed and they just need money. They give each person 80 files and they slam them through and overwork everybody. And don't be surprised if your file takes a while or nobody calls you back. But that's what you get when you want that. So there's different types of. As a broker, that's the good part. We can send it anywhere, and I always send it to the best place for that client. So. That's what I would say about it.
How does that as a broker, do you get like updates from these lenders on where they're at with their workload?
Yeah, we have a software that can sift through. It's actually called Loan Sifter. And it sifts through all the lenders and how they're pricing today versus yesterday. So it tells you this, lender ABC went down or went up. And a lot of it has to do with the market, but a lot of times they may price worse even when the market does better, because there's some internal issue or some internal reason. That's not always the case that every lender prices better on a good day.
Right. And so for tips, if you're refinancing and you were in line to get refinanced and then all of a sudden the lender says, oh man, sorry, rates just bounced up a point and it makes no sense for you to now refinance. That's just temporary, guys.
Right.
That's temporary. You need to stay in line, right?
Right.
And wait till you get to the front of the line and the rates, that lender clears their pipeline and they drop their spread. So the rates drop, right? Don't give up just because somebody said, oh, you missed the boat. Rates bounce back up. Just stay in line. Do you agree?
Yeah. Yeah. There's a lot of people right now with prepared files waiting for that next wave to come back down so we can lock all those rates in because they missed that last wave. So when your lender calls you and asks you to get your items updated, you better update them pretty quick if you don't want to miss that opportunity because it might change in a split second. So that's what I would say, to the people out there listening. because I reached out to people, and I think only 20% were able to lock in time because they just couldn't get their file together quick enough. It was all the engineers and accountants who were all organized that got their loans locked.
Okay,
Everyone else,
I got one last question for you, Albert. Okay, and then we're going to let you go back to work in beautiful California there. So one of the things I saw you say one time was income is income, contrary to what folks say. However, each type of income has different time frames for how long you have to receive it and how long it is documented before you can use it. An example might be alimony, where you need to receive it for a minimum of 3 to 6 months with documentation for 3+ years, continuance to use it.
Right.
Or interest.
An example?
Be a minimum of 12 months.
Right. So if you're trying to do a transaction and use the income to qualify with it, it's important to know how long you have to receive it or pay it. If you're the payer, sometimes people are paying alimony. So you have to know how it affects you. If you're the payer or the payee. And if you're the one receiving the income, how long do you have to receive it for a lender to use it? That's important. So
is there any type of outline like on common types of income that you see as a lender?
Yeah, there's something called the Fannie Mae Selling Guide. It's about 1,178 pages or something. But other than that, digging through that and going to the income section and reading it, we have to follow all those rules, and they're constantly updated every other week or month. So that's what we follow.
Basically, call Albert, guys. Right?
Yeah. I mean, if you want to.
The other thing is I think of lenders like doctors. You should be doing a check-in or a checkup with your lender, every 6 months or 9 months or something like that. You need to pre-plan your, what is it? You think people need to pre-plan a year ahead or 2 years ahead when they're talking to their lender?
Yeah. And sometimes, they're trying to come to you and they're a better client for somebody else sometimes. And, we all love to help everybody, but the reality is we can't. And I have the specific people I want to serve. So if I spend my time helping all the people that aren't a good fit for me, I basically alienate my loyal people. So that's my dilemma too. And I always want to make sure I take care of my people first.
Do you have referral people that you like to refer to though?
In terms of clients? Or do you mean like partners?
It's not a match for you. Do you feel like
you
have?
Yes, I do.
Absolutely.
And the people I refer to, they're more than happy to take it because that's their model. They know their model. That's what they're good at. They're better at me at that model. So
exactly.
Yeah, we can't do everything unless we want to be jacks of all trades, but master of nothing.
Well, good tips today, brother.
Yeah. Thank you.
Good stuff. So how are people able to connect with you or?
They can give me a call. The number is 425-951-5300, or they can email me. It's at Albert, and that's at Avenue, the number 1, cap.com. So those are my contact information.
There you go, guys. Hey, Joe, while we're at it, this is such a good podcast and we're talking about CPAs. Why don't we link Mark Canton's podcast and also Natalie's podcast, which is the funny one. You guys will listen.
There's a dog snoring, right? I remember the dog snoring.
Both super talented accounting types that work with investors. Like we said, not everybody can handle all the business themselves. So spread the love. And those are two people that we would highly recommend for sure. Of course, along with Albert here as one of our favorite lenders. We have a lot of great lenders here that we talk to at Seattle Investors Club. Of course, we love certain lending on the hard money side. We love Albert. We love our friend Keith, who contributes. Keith's over at Loan Depot. Keith Pitch, who contributes to us on a regular basis. But Albert, I got to tell you, you are the man when it comes to this ninja deep dive stuff. So
Thank you. Mucho. Yeah, it just comes through because of the experience. You have to go through it if you're doing it yourself. So I think that's the main reason. Excellent stuff, guys. Well, be careful when you're filing your tax returns right now, guys. Yep. Start thinking about these things because I know you're all dragging your feet till the end to get this done.
I wonder if they're going to delay the federal tax payments. What do you think? You want to make a side wager on that?
I don't know. What do you think, Joe? We'll let Joe.
Even though I haven't looked into it at all, my gut would tell me that they will, based off of what we've been seeing so far.
Seems like something's got to happen, right? But who knows? Well, guys, be safe, be healthy, and we will talk to you next time. Albert, thanks again for connecting with us. We no longer have right now, at this time, we've suspended all our in-person weekly Seattle Investors Club meetups, but good news, everybody. We are launching an online meetup through Zoom. We have no idea how it's going to go, but we all know we love talking to each other every week. There will be no topic. We're going to jump on there, and we are just going to talk to each other like we do at our regular in-person meetings that we've done in Burien and Redmond and Milton and all that stuff. Maybe it'll even be more fun because we can get all the East Side people, Pierce County people, all the Seattle area people, all the people up north. We can all get on there together. It's an important time for us to stick together. This is going to be weekly on Thursdays, I believe. And check your email, check Seattle Investors Club Facebook page, and we will be getting that announced out to you. If you have not joined our Seattle Investors Club Facebook page, now would be a good time to do that, just so we can all stay connected. And again, Albert, we hope to see you soon. And Joe, where can everybody find the details of today's podcast? Oh, yeah. One last thing, guys. Don't forget, today is March. Well, we'll probably miss the date. If you've already missed the date, too bad. But you need to get your tickets to the Big Badass Real Estate Wealth Expo that is happening this summer. Still scheduled, still happening. I believe it's July 10th through the 12th. And you need to go and look at the Fixated on Real Estate site, or just Google Pacific Northwest Big Badass Real Estate Expo and grab your
awesome.
ticket. It is going to be more important than ever to get yourself educated and get amongst your peers when we're able to get back together in person. And that's going to be the event that we're going to be able to do that at. I'll be there. Albert, you going to be there?
Yes, I'll be there. Can't wait.
All going to be there. So let's
just
go.
To give a shout out to Grace and Tarl for putting it on,
That's right. Of course, yeah. Grace and Tarl, Fixated on Real Estate, our friends. If you're not part of that group, highly, highly encourage you to jump on and find out more information about them as well. But please go buy your tickets before they sell out for this event of the year here in the Pacific Northwest. And again, I'll let Joe tell you about the details on where to find the show notes and all the awesome links we're going to include in today's podcast.
Heck yeah, you guys can get to the show notes and all the links, including the expo that's coming up in July, by going to seattleinvestorsclub.com/109. That is seattleinvestorsclub.com/109. And as always, we are looking for reviews. If you like this podcast, we'd love to read your review out on the show. And if you guys wouldn't mind, if you haven't given us a review, would you please do that? I'm trying to see if our system is actually letting us see the reviews. So give us a review, let us know that you did, and hopefully it's an awesome review and we can read it on the podcast.
Hey guys, I want to add one thing on here as a little wrap up here at the end, since we're all stuck here. Not stuck. I personally am going to enjoy my family time with my kids, really have some quality time over these next few weeks, but we could get a little stir crazy. And I want to remind you guys all that our very own Mr. Joe Bauer has the Get Better Project, which is a perfect time. I'm actually even going to do it with my kids to jump on and get your fitness game on from our talented Mr. Joe Bauer here. Joe, tell us a little bit about that and how everybody can check that out. If you guys are feeling cooped up, for God's sakes, you need some exercise. Even if you don't exercise in the past, this is a good time to start. Give you something to do too, and something great to do with your kids, honestly. That's how I'm looking at it. So give me the details on that, Joe.
Yeah, it's my online at-home fitness program that is designed with 1 through 5 different levels based off of your exercising talents. 1 being like you haven't exercised in forever, and 5 being you're really good at it.
Hey, we're my number ones. Just kidding.
I even do the number 1 sometime too, and it's designed to be able to do with little to zero equipment. So it's based off of the workouts that Emily and I do on a regular basis, and we know that they work. And you get me as your coach. So you can ask me any questions that you would like to, whether it's on fitness, nutrition, health, or stress, or sleep, or whatever it may be. So I'm here to help out. And right now, because of this crazy time, if we're still having the virus issues, I'm giving away 30 days of the program so that you can do this from home without having to expose yourself at the gym. So just contact me, joe@thegetbetterproject.com, and I can get you started.
So rad. We're here for you guys. We love you guys. And be safe, and we'll talk to you again soon. Ciao, ciao.
I appreciate it. Thanks, guys.
Thanks, Albert.
Bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.